Brandon here from B2R Investing and Financial Talk. Today's topic, six-man football and the two investing numbers you need to understand. How do they relate? I pray that you have stewardship of the knowledge and money you are entrusted with. Let's get started. Stay with me to the end. There's good discussion at the end, but I want to hear from you. Maybe you think there's something else that is the most important financial metrics that people should understand. Let me know in the comments what you think should be the number one thing people should understand if you think something's different than what I'm discussing. Look forward to seeing your comments. Let's get started. What I love on the example of six-man football, it's usually very high scoring, and when those teams are close to equal, it's usually the team that has the ball for the very last possession. And what the other team that loses wishes they had is just a little more time. I want you not to be one of those people that loses wishing they had just a little more time. Because I'm going to show with the law of compounding and investing in the stock market versus investing in real estate, you do not have enough time, and the numbers from the government prove it. So let's get started. So I want to talk about the law of compound interest. And everyone typically understands it in the positive, but doesn't realize that it also works in the negative. Let's start out with that positive example. So if you had $1,000, for simple math, $1,000 to invest, and that investment earned 10% in the first year, of course you would earn that $100, and your investment then, now it's worth $1,100. If you earned an additional 10% year two, not only would you earn 10% on the original investment, now you're earning 10% on the interest you earned in year one, so that 10% now is worth $1,210, and so on and so forth going forward, that interest is compounded, and now you're not only just earning interest on the original investment, but you're earning interest on the interest you earned. But what a lot of people don't understand is the negative compounding. It has just the same magnified effect as the positive. Let's use an example, and I'm just going to use the general stock market as an example and to show you what happens. So if you look at the same 1,000 you invest in year one, and I'm going to use the negative example. If it were to lose 10% year one, what would it take year two to get back just to break even? Well, you don't have to earn 10% back. You actually have to earn 12% just to get back to break even. So the year one you lost 10%, now it's $900. You would have to earn 12% year two, a magnified earnings, just that law of compounding to the negative. Now you have to earn 12% just to get break even. So I want to also show an example with a 3-year return. And this has happened multiple times in our lifetimes. 1 year it went down by 20%. What do you have to earn to get back to break even year two? The market has to earn, or your investment has to earn 25% just to get break even year two. Then let's use an example, year three, it earned again another 20%. So on this same $1,000 investment, after 3 years, first year losing 20%, second year gaining 25%, and the third year gaining 20%, Your investment now, only after year 3, is only worth $1,200. So what they would use, and what the stock brokers and different people in the stock market, they want to sell you, is they use the annual metric of average rate of return. What I want you to do is, if you're going to invest in the stock market, if it's some general mutual fund or S&P 500 fund, is ask the question over a previous period of time, what is the actual real return looking backwards if you were to do that same investment? They will always typically talk from average rate of return, and I'm going to show you the difference. They're using these numbers as simple numbers, -20, +25, and +20, and taking those three data sets and dividing it by 3, which would give an average return of 8.3. But that's not the real return. With all those 3 data sets over 3 years, you only earned $200 on that $1,000. What is the actual real return over the 3 years is a totally different number. That actual real return is 6.6%. You want to understand the law of compounding, and if you're investing in anything, what is your actual real return over whatever period of time? That is a very important number. You need to know, first off, what is your real return on your investment. Understand that law of compounding both works in the positive, but also works in the negative. And what I always share is, you want to understand compound interest. Those that do, earn it. Those that don't understand it, pay it. Can you imagine, with the average person has $6,500 in credit card debt, and the actual average interest paid to those businesses is almost 22.5%. How much interest, if you were paying the minimum payment, how much would you pay from the original purchase with that $6,500? It would be double, triple, sometimes, depending on how long you paid that out. If you paid the minimum interest, it could be multiples of the original purchase. Understand the law of compound interest. Now, I would say one of the more important numbers you want to understand, or the rules, is the rule of 72. And what that is you take the interest you earned into a real number. Let's just use the example, because the stock market, what I think is very interesting, over the years, I was a stockbroker 2 or 3 decades ago now, and what we used to use was the average return of a little over 12%. And what I've been hearing in the recent past, guess what they're saying? That number has changed. Now they're using average returns of 7 to 10%. And I think that's very interesting that they've changed that number and it has gone down. But you take that actual number and divide it into 72. So I'm going to use 8 from our calculation. Use 8 into 72 as a return. You take that number, and that's the number of years it would take to double your money. That is a very powerful rule that you want to always be thinking about, is what are my returns on my investment and how quickly can my money double? So, like I said, 72 divided by the 8 in the 8% equals 9 years. So what I'm looking at, when I'm looking at real estate, I'm holding my money accountable. And I've shared in many videos the 4 different conditions of money, and the wealthy understand it. 0 to 4% is considered dead money. This is money that's barely keeping up with inflation. Then there's safe money, which is basically 5 to 7%, 5 to 7, 5 to 8%. That's safe money, typically in some form of dividend or bond type of money. And the stock market would be considered healthy money, running between 8 and I would say 8 or 9 to 13% into healthy money. But where the wealthy live and they hold their money accountable for their investments is 14% and higher, because they understand how their money grows and understand compound interest and the rule of 72, having their wealth double much faster, getting ahead of inflation. So I want to use an example here. This is a recent build investment that I did, year 1 and year 2. And I want to extrapolate this out to understand how your money works so much more in real estate, because it grows 5 different ways versus most of the stock market. For a typical investor, either grows with the growth of the stock or a dividend. Yes, there are other more advanced strategies, but it's much riskier. But those are the 2 primary ways the stock market grows. But real estate grows 5 different ways. From cash flow, from principal pay down using other people's money in a safe way, the tax benefit and not having to pay income tax on probably all or at least most of the cash flow, from natural appreciation, and the 5th, which some people can do, I call it the magic, is being able to buy a property and do forced appreciation, doing value add to that property. That's a magical way, of the 5th way of earning money in real estate. So I want to talk about some basics to a recent build. So year 1, I invested, my total investment was $29,000 into this single family home that was a cash flowing investment property. The cash flow on this property earned 13.5% cash on cash return. But that was just one way my investment made money. The second way was principal pay down. And of that principal that I paid down for that year on only investing $29,000, I earned a 7.1% return on that principal pay down. The same thing, this had forced appreciation, and the forced appreciation was almost $60,000 on this build, and that represented 182% for a first year return on my money on just those 3 components was 203% for $58,900. Now year 2 that changes because I don't have that same forced appreciation. But I want to use this as an example. So year 2, let's just say the rents don't change. 13.5% cash flow still on that same $29,000. Now the principal paid down year 2, and these are 30-year fixed rate products that I always use on my investment properties. I want to control that cost with 30-year fixed rate financing. But year 2, it gets even more. It's represents 7.6% of my initial return. And I'm going to use a return on natural appreciation. An interesting fact, since 1940, every decade, real estate has appreciated. And you may want to know that the lowest appreciation was in the 1990s, and it still represented 30% appreciation. And from the 2020s till today, here in 2025, we are at over 45% appreciation. That's not including the next 5 years. But recently it's been pretty flat. But I'm going to use a calculation. The average has been over all the decades is 4.5%. Well, I'm going to be extra conservative, cut that in half, and say that represents 2.25% appreciation on the initial build. Well, that represents 2% to my $29,000 that I invested for a return of 23.1 over time over a typical 10 years. So I want to go build this out. I'm going to use those numbers and assume that my cash flow never changes over that 10-year period, though we know historically in the past it always goes up over a period of time of 10 years. But I'm going to keep that same 13.5% and using natural appreciation of only 2.25% a year over a decade. So I want to be extra conservative in this scenario to show the beauty of real estate versus the stock market. I believe if you look at real returns of a typical mutual fund, you're going to be looking closer to that 8%. And that doesn't factor in what I call it, and I've heard others, Jason Hartman says it, the CP lie. When they say inflation's 3%, you probably could almost double it what we actually experience. But let's just use 3%. If you're earning 8 and inflation is 3, you're only gaining 5%. You can't get there fast enough. The statistics show that the typical person only saves to $1 million in their retirement account is only 3% that only reach $1 million. That is not the business plan that I chose. I wanted to get there faster using real estate because the returns were better. So looking here, and I want to give another example. So on the rule of 72, say you were to earn 16% because we're living where the wealthy live, 14% and higher. Say you were earning 16% on your investment, your money now doubles at 4.5 years, twice the speed of what 8% does. Now, you say, what is this real estate project that I did? What's the return over a typical, and I'm going to use the same period, the same 9 years. What is the doubling? So this one first, let's do the 8. You've earned 8% for 9 years. Your investment in 9 years is now $58,000. That is your return. You can see there, you can't get ahead fast enough. There's only 3 ways in that saving your way to wealth. You either have to put more money in every month or start from a higher initial investment, or another way. That's why only 3% get there in retirement plans investing in the stock market. So if you were to earn 16% on your investment, and this is somebody focusing on a specific thing, 16% after the same 9 years is now $116,000. Significantly more. You can get to financial freedom that much faster. But now I'm going to use this scenario of this over 9 years, this rental property, the returns, the principal pay down, the natural appreciation, and only staying constant at 13.5% cash on cash return, though we know over a 10-year period it would be higher. What would this return be in 9 years comparing apples to apples? $192,000 on the same 9-year period. $58,000 in this stock market scenario versus $192 looking at history going backward using our scenario. Your value with the principal pay down, the natural appreciation at 2.25%, and receiving 13.5% cash on cash return every year with that $29,000 investment, you're now almost 4 times the value, not quite, and your money is doubling, not quite 3 times in that same nine years, but a little over 2.5 times. This is where the wealthy live. This is why I invested in real estate. I'm getting to financial freedom. What I would say for most people to get to financial freedom, you're probably going to need 4 to 5 investment properties and a 10 years period, give or take a few years. You can get to financial freedom in 10 years. In the stock market, you're looking at selling your life for 40 years plus, and just like football, in 6-man football, usually the winner is the last one that has the ball, and the other that wants to win, they just need more time. This is the problem. of investing in the stock market unless you have a lot to put in and a lot to put in initially. Most do not get to financial freedom. The final example, and I used this with my kids, my teenagers, to get them to start understanding the concept of the rule of 72 and the law of compound interest. Would you take 1 penny doubled every day for 30 days, or I give you $2 million? Which would you take? Ask this of your kids. Let me know what they say in the comments. You want to teach them to understand investing and getting higher returns on their investments. So in the first 10 days, that penny is now worth only $10.24. It's doubled 10 times, starting with a penny, and in 10 days it's worth $10, not much. In 20 days, now it's worth $10,485. Now we go for another 5 more days. It's starting to become significant, but it's still not enough. It's still not that $2 million. It's only worth $335,000. Where does the magic happen? It's in the number of times your investment money doubles. Those last 5 days. I didn't put it on here. The last 5 days, the last 5 times that money doubles, on the 30th day, it's worth $10.7 million. The magic is the number of times it doubles. That is why you want to understand and always be thinking about the rule of 72 of your investment. What is the return over time? Am I getting above 14%? This right here with real estate, this is why I invest in real estate. What would you say this compound interest similar return? It's close to between 19 and 20% compounded. That's how you get to this $192,000. I can't get to financial freedom fast enough at $58,000. I hope you enjoy this. Tell me what you think is a good financial metric others should learn and is very important. There's quite a few, but I think this is core financial principles, is understanding compound interest and the rule of 72.